Hello, everybody. This is PRMIA's Intelligent Risk, and today we are interviewing the authors of the capstone article that we will be publishing in our May issue. The title of the article is Strengthening Resilience Through Behavioral Risk Management, and I'm delighted to welcome today to my interview the two authors of the article, Wieke Scholten and Alex Chesterfield. They are two experts in the specialized field of behavioral risk management. They've written articles, they practice advisory services, and they both have very extensive backgrounds in various risk elements, in particular focusing on risk culture and behavioral risk in the financial services industry, in regulated industries. And the rest, well, you'll get to read about their specialized expertise when you read the article. But today, I'm going to have them just briefly describe what prompted them individually to bring their talents to bear on this sector of the risk management universe, and a little bit about what they're hoping to achieve with the article that you'll soon be reading in our May issue. So, Vika, let me start by handing over the mic to you, and let's hear from you. What brought you to specialize in the area of behavioral risk management?
Thank you, Steve. Behavioral risk management from a Dutch context, because I'm dialing in from the Netherlands, in financial services started really when two Dutch banks failed in about 2008, after the great financial crisis. The Dutch central bank thought to prevent these type of events, we should also include a behavioral perspective. So the premise, right, the basis of this work is the understanding that problems or poor outcomes, issues always also have a behavioral cause. So it helps if you want to prevent and have more forward-looking risk management to then add a behavioral perspective. And as a social and organizational psychologist, I'm, of course, endlessly interested in how we behave at work and how we do things here, and aspects of how we do things here how that relates to potential poor outcomes. So that's what got me into it.
What you, Alex? What brought you then not only to partner with Vika, but also to focus your expertise on this part of the risk universe?
Yeah, great question. So I've always been really hyper curious around why people do what they do or why people think what they think. So formerly studied cognitive and decision science a long time ago now, but there were two reasons that drew me into the risk, applying behavioral science in a risk space, which is quite niche. The first was I had set up and led a behavioral science team at Europe's largest consumer association, so in London, in the UK. And when I was working there, I'd seen so many consumer problems, whether it was in energies or people getting ripped off in financial services or not being able to get an appointment with their GP. So I saw at the sharp end from users or citizens or consumers the problems that people were experiencing. And I began to wonder, why are these happening? They're very common patterns across very different industries. The second motivation was when I moved into the regulator. And again, initially, I was spending a lot of my time researching the different problems that consumers were facing in very different financial services markets. And it sounds cliched, but I had one of those real light bulb moments when I thought, why are we spending so much time and resource looking at downstream problems when actually we need to be looking more at firm behavior to try and prevent the problems happening downstream by focusing more on upstream, i.e. the firm, the behaviors and what drives those behaviors within a firm. So after spending a few years at a regulator in their behavioral economics team, I then went into the bank, which is where I met Vika. So Vika was my predecessor at, I think, the UK's largest commercial and business bank. And that's how we met, and geeked out a lot on what was the emerging field then of behavioral risk.
Right.
That's terrific. And I mean, I know our audience hasn't had a chance yet to read what you provided for our upcoming issue, but the whole idea that individual behavior is one area of analysis, but group behavior and the way in which group behavior, as you highlighted, not only can dictate how an organization addresses the risks which it has to deal with, but in also it can also affect how well it interacts with its customer base, with the economy at large. And so with the scientific skills that you each bring to this topic, that sort of shifts the focus. I mean, it's part of the sort of the lexicon of risk managers that we focus very nearly on individual and specific situations. But most of us, and I'll certainly speak for myself, we don't have the scientific background to be able to view behavior from this more sort of expanded view that is part of the training that you two acquired. So I'm sure this is going to be a really interesting journey for all of our readers. But perhaps you could, in a few words, you could also help our readers to understand what it is that you think that they will be able to do, or what kind of impact you hope that you will have when they read the article and the takeaways that you've provided in it. So why don't I switch back to you, Wieke?
Yeah, so I think what we hope, and I'm also keen to hear what Alex has to say about this, but what we hope is that with this article, we give a clear sort of case for adding that behavioral perspective, because it does help an organization to prevent future problems. So to be more forward looking in your risk management instead of responding to issues, that you can better prevent them by adding that behavioral perspective, which is, the word behavior. Some are, for us, it's a very common word to use, but what we mean by that is, how do we do things in an organization? How do we make decisions? How do we communicate? How do we work together? What are aspects of how we respond to shortcomings, like the typical, ways of let's say current practices in an organization. And aspects of that can lead to good outcomes, but can also create poor outcomes. And to have more a systemic view on that, systematic view, and being able to analyze what patterns are in how we do things here, is for a behavioral scientist, of course, common. So I think one of the cases that we make is, there's a structured approach to this, and you don't need 15 behavioral scientists with PhDs and whatnot to do this. You can just add a bit of behavioral science, add some of this expertise to your current risk management practices to help improve impact and effectiveness. And the great thing is, we've been doing that for 15 years now in financial services, because after the regulators indeed started to initiate this, the firms quickly followed. So there's great experience already in building this capability internally. And we want, with this paper, to show some practical cases on where that has been effective, so that it hopefully inspires to add this perspective to risk management.
That sounds great. Alex, I'm sure you have a complementary perspective. So what do you think our readers will be able to implement after they read your description and your examples? What will they be able to take away into their day jobs from your article?
Yeah. So I think 2 points from me. So one is, I hope readers will take away, similar to Vika's point, that understanding, assessing, changing behaviors can be done in an objective, systematic and scientific way. Often people perceive anything to do with people or humans as, fluffy, it's just anecdotal, and it absolutely isn't. I mean, there's decades of science behind this. So that was the first thing I think I would like readers to, that I hope they take away. The second thing is that behavioral risk can really add value to your organization and is a real asset to a risk or audit or compliance function. So given its roots and mandate in preventing failure, the term behavioral risk often carries a negative connotation. But I think firms, especially in the last, I say 3 to 4 years, have really seen that the same insights that prevent crises and problems can also drive long-term success. So by systematically identifying drivers of particular behaviors, firms are not only mitigating risks, but also enabling shifts in behavior over time that support all the outcomes that firms want. So intelligent risk taking, as we were talking about before, we're not looking at zero risk. Obviously, firms need to take a particular amount of risk. Um,
Go ahead. Yep, we're still on.
oh, am I still here?
Yes, we are. Yeah, we still got you. Don't worry.
Record that bit? No, it's fine. Where was I? So that's it. So basically, so they can support desired outcomes like intelligent risk taking, strategic transformation, and better customer, more satisfied customers, customers that advocate for your company, customers that go and buy, or a better longer term quality customer. So a whole bunch of positive outcomes. So it's not just a way to prevent problems, but it's also increasingly being seen as a capability that helps firms drive value all round. That's the second thing I hope readers to take away.
Well, I'm sure the readers are going to find out for themselves. I know that when I had the privilege of seeing the article and when you submitted it, what really caught my attention was that that, as you say, there's been this capability has existed for for years, but maybe has been underdeveloped in the risk sort of taxonomy. But with the advent of better tools for capturing data, not just digital data, which of course is something risk managers are working with on a daily basis, but unstructured data. And I think you go into some details about that in your article, that the scientific approach that obviously needs to have raw data that can be then converted into scientific analysis, the greater development of AI and other types of tools that can convert what would otherwise simply be noise into analytical content, really feeds or kind of provides ammunition for practical implementation of the methods that you describe. And there's a model that you provide in your article that hopefully will be widely recognized by our readers. But mostly what I want to say is, we are so fortunate to have professionals with your level of expertise willing to share your expertise. Our publication is the definitive expertise from practitioners to practitioners. And so every time that we get a chance to be able to show the sort of advanced developmental techniques, such as the ones that you two practice, I think we're opening up new channels for our audience to be able to improve their capabilities, improve the outcomes for their organizations, and of course, keep coming back to read our publications every quarter, because that way we can continue to make an impact on the risk profession, thanks to expertise of authors like yourselves. So that's all we have for today. We just wanted to let our audience know that the real event is going to be when the publication comes out in a couple of weeks. But really, Wieke and Alexandra, it's been great to have you share your expertise to bring your work in the publication alive with this interview. Thank you so much. And everyone, stay tuned. As soon as you get the chance, you'll be able to read their article. And of course, if you have any feedback, you can always tell the editors. We love to hear feedback, and our authors love to hear too. If there's something in their article that you felt was very, very impactful, or some additional suggestions, some experiences of your own that you'd like to share. That's what our publication is all about. Expertise shared by experts with experts, and the circle goes on. So thanks, everyone. Thanks for listening. Thanks for watching. Wieke and Alex, thank you so much for contributing. And we're really excited to see your article published in just a week or two.
Thank you.